Then section 45A is capital gains on damage or destruction of capital asset. So capital gains on damage or destruction of capital asset. Now basically these are capital gains in special cases. That is capital gains in special cases. And 45(1)(a), it begins with a non-obstinate clause, that is notwithstanding anything contained in section 45(1), notwithstanding anything contained in section 45(1). So it begins with a non-obstinate clause, that is notwithstanding anything contained in section 45(1). Now here there is damage or destruction. There is a damage or destruction of capital asset, and this damage or destruction has taken place on account of, say, natural calamities or, say, accidental fire or explosion or action by an enemy or action taken in combating an enemy. Action taken, say, in combating enemy, whether with or without declaration of war. Or there is what? Riots or, say, civil disturbances. By virtue of these, capital asset has been damaged or deteriorated. So whatever insurance compensation is received, whatever insurance compensation is received, that is money plus fair market value of asset which has been received, same will be regarded as, same will be treated as full value of consideration. Same will be treated as full value of consideration, and capital gains shall be chargeable to tax in the year in which such compensation is received. In the year in which such compensation is, say, received. So what section 45(1)(a), it begins with a non-obstinate clause. Since under 45(1), fundamental thing is there must be capital asset, and here it may be possible that this capital asset has been, say, damaged. So here it has been, say, destroyed. There is no capital asset, still capital gains is chargeable to tax. Therefore, it begins with a non-obstinate clause, notwithstanding anything contained in section 45(1). So what 45(1)(a) provides is where any person at any time during the previous year he receives any money or other assets under insurance from an insurer on account of damage or destruction of any capital asset on account of, say, floods, typhoon, these damage or destruction has taken place as a result of, say, natural calamities, flood, typhoon, hurricane, cyclone, earthquake, or other convulsions of nature, which may be on riots or civil disturbances, accidental fire or explosion, action by an enemy or action taken in combating an enemy, whether with or without declaration of war. In that particular circumstance, whatever is the money plus fair market value of the asset which has been received from insurance company, the same will be regarded as full value of consideration, and the capital gains will be taxable in the year in which such money or other assets has been received. And basically here it has been given an overriding effect over 1 year self case, but for the limited cases That is, when capital asset has been damaged or destroyed on account of natural calamities, accidental fire or explosion, action by an enemy, or action taken in combating an enemy, whether with or without declaration of war, or rights or civil disturbances. Now, one question is there: Mr. A is an individual who is carrying on business. His stock and machinery were damaged and destroyed in fire accident. So here, his stock and machinery was destroyed. Value of stock lost, total damage is rupees 6,50,000. Certain portion of machinery could be salvaged. The opening WDV of the block as on 1418 is 10,80,000. And during the process of safeguarding the machine and in firefighting operations, he lost his gold chain as well as what? Diamond ring. The same has been purchased in April 5 for rupees 1,20,000. FMV of these items, that doesn't matter here. Now, if stock is lost, insurance compensation so received will be taxable under PGBP. So what it has been further provided is Mr. A receives the following amounts from insurance company towards loss of stock 4,80,000. So here 4,80,000 rupees will be chargeable to tax as profits and gains of business and profession. Same will be regarded as revenue receipt. Then 6 lakh toward damage of machine. So here the WDV of the block of machine is rupees 10 lakh 80,000 and we have received rupees 6 lakhs. Whatever insurance compensation is received, that is rupees 6 lakhs. So here 4 lakh 80,000. In case if there is any other machine in the block, depreciation will be admissible. If there is no machinery in the block, entire machine has been damaged, therefore it will be a short term capital loss. In case of depreciable asset, it is short term capital loss. And towards gold, chain and diamond, these are capital assets. Personal jewelry is a capital asset. So the capital gains will be computed as under what is the full value of consideration, that is 4 lakh rupees, less index cost section 120 divided by 2005-6 index. What is 2005-6 index? 5-6 index is 117 into 280, that is 2,87,179, and resultant sum will be long term capital gains. How much long term capital gains? It will be 1,12,821. So this will be the resultant LTCG. This has been asked for 7 marks in November 2006 exam. Now 45.2 is conversion of capital asset into stock in trade. So here year of transfer, as you read the definition of transfer under 247. So year of transfer is basically year of conversion. Year of transfer is year of conversion. When you convert capital asset into stock in trade, so you will be using CIA of that year. And the here fair market value on date of conversion, fair market value on date of conversion becomes what? Full value of consideration. What is a full value of consideration? Fair market value on the date of conversion. This is to be kept in mind. This is an important one. Year of taxability, previous year in which the stock is sold. Capital gains is chargeable tax in the year, is chargeable to tax in the year in which such stock is sold. The same is chargeable to tax in the year in which such stock is sold. And business profits is, what are business profits? Sale proceeds of stock minus the fair market value on date of conversion. So here, conversion of capital asset into stock in trade, capital gains is fair market value on date of conversion less index cost action or improvement. Indexation benefit will be considered in relation to the year of conversion of say capital asset into stock in trade. Business income is sale proceeds minus fair market value on the date of conversion. Now, one question is there: Under converts his plot of land purchased in July 2003 for rupees 80,000 into stock in trade on 31st March 18. So, financial year 17-18 cost inflation index will be used. That is to be kept in mind. And FMV as on 31st March 18 is what? 250. So, this will be regarded as full value of consideration. Stock is sold for 275 on January 19. Capital gains will arise in assessment year 1920. So capital gains financial year 18-19, assessment year 1920. So what is full value of consideration? Here full value of consideration is fair market value on date of conversion. Fair market value on date of conversion. What is the fair market value on date of conversion? That is 2,50,000 rupees less index cost section. He has acquired for 80,000 in 34 index is what? 109. 34 is 109 into, it will be not 280, here it will be financial year 17-18, that is to be kept in mind, year of conversion. So here it will be 272. So what will be the resultant amount? That will be 1,99,633. So this will be long-term capital gains. How much LTCG will arise? 50367. Business profits. What is the business profits? Business profit is 275 minus 250. Fair market value on the date of conversion is this now cost. So 25,000 rupees will be the business profits taxable in assessment year 1920. Section 45(2)(a) is capital gains in case of transfer of shares held in demat form. So here first in first out principle will be followed for computing period of holding and cost action and capital gains shall be chargeable to tax in hands of depository beneficial owner and not the registered owner. So it will be chargeable tax in hands of the beneficial owner. So you say Mr. X is having a demat account and he has purchased 1000 shares of CP Limited on 15/7/2018, and again 1500 shares have been acquired of CP Limited on 10/9/2018, and he transfers 1250 shares on, say, 15 August 2018, so 2019. Then for 1000 shares will be treated as first transferred out of 15/7/18, and remaining 250 shares will be out of 10/9/18. So here the principle of FIFO will be followed for determination of cost action and period of holding. And as you are aware that long-term capital gains is chargeable to tax under section 112A. Short-term capital gains is chargeable to tax under 111A. The same will be discussed when the taxability will be discussing the taxability of the capital gains. So where any person has at any time during the previous year he has any beneficial interest in any securities, then the profits and gains which is arising from transfer which has been made by depository or participant of such beneficial interest in respect of such securities shall be chargeable to tax as the income of the beneficial owner of the previous year in which such transfer takes place, and the same will not be regarded as the income of the depository who is deemed to be the registered owner. And further, the cost section and the period of holding shall be determined on FIFO basis. Then next is section 45(3). Now what section 45(3) provides is transfer of capital asset by a partner of firm there is transfer of capital asset by a partner of firm or say member of AOP or BOI, member of AOP or BOI, member of AOP or say BOI. The transfer of capital asset by a partner of firm or member of AOP or BOI not being company or cooperative society. Not being company or cooperative society as capital contribution or otherwise. So the asset has been transferred by a partner of firm or member of AOP or BOI as its capital contribution or otherwise. In that case, amount recorded in the books of firm or say AOP or BOI, the same shall be treated as full value of consideration. Shall be treated as full value of consideration. And capital gains shall be chargeable to tax in the hands of partner or member in the previous year in which such transfer takes place. So fundamentally, if you are bringing any capital asset in a partnership firm as your capital contribution or otherwise, whatever amount is recorded in the books of the firm, the same will be regarded as full value of consideration, and the capital gains will be chargeable to tax in the previous year in which such transfer took place in the hands of the partner or member. So, Section 45(3) provides the profits and gains arising from transfer of capital asset by a partner of or a member to a firm or EOP or BOI, not being a company or cooperative society, by way of capital contribution or otherwise. The same shall be chargeable to tax as capital gains. What is the full value of consideration? Whatever amount is recorded in the books of accounts of the firm, EOP or BOI, the same will be regarded as full value of consideration, and it will be taxable in the previous year in which this transfer takes place, and taxability will arise in hands of the partner or member. So here one question is there: X and Y form a partnership firm. Just after formation, X has brought the following assets on 13th October 18 as his capital contribution. So here amount recorded in the books of the firm will be regarded as full value of consideration. He has brought gold ornaments. He has brought house property. So here full value of consideration is 950 and 60,000 less index cost section or cost section, that is 262,500 upon 100 into 280, 262,500 divided by 100 into 280, that is 7,35,000, and this will be short-term capital asset 36,600. So long-term capital gain is 9,50,000 minus 7,35,000, that is 2,15,000, and here short-term capital gain is 60,000 minus 36,600, that is 23,400 will be short-term capital gains. Even if the assets have been brought otherwise than by way of his capital contribution, the taxability will remain same. Then 45(4) is distribution of capital asset by firm, AOP or BOI other than company or cooperative society to partners or say members on dissolution or otherwise. So here is a distribution of capital asset by firm or EOP or BOI to its partners or members on dissolution or otherwise. Here the fair market value on the date of transfer we will regard it as full value of consideration, and capital gains is chargeable to tax in hands of firm, AOP or BOI, and here otherwise expression covers retirement of partner also. The retirement of partner is covered under section 45(4). So whatever profits and gains which arises from transfer of capital asset by distribution of capital asset on dissolution of firm or other AOP or BOI, not being company or cooperative society, or so dissolution or otherwise. The expression otherwise covers what? Retirement also. The capital gain shall be computed as under full value of consideration is fair market value in the date of transfer, Year of taxability is previous year in which this transfer takes place, and the same will be taxable in hands of firm, AOP, or BOI. Now, one question is there whether Roy and S are partners or members in Ram and Associates and AOP. Ram and Associates was dissolved on 14th February 19 and the following assets were distributed. So here the fair market value will be regarded as full value of consideration. Taxability will arise in hands of Ram and Associates, and cost action has been provided. This is short term, this is long term, and fair market value is also there. So capital gains in hands of Ram and Associates. So full value of consideration in case of HP, it is 17 lakhs less whatever is the index cost action, 450 divided by 100 into 280. That is 12,60,000. And in case of listed securities, 10 lakhs, and whatever is the cost of acquisition, that is 7,70,000. This will be 2,30,000. Same will be short-term capital gain, and this is 4,40,000. That is long-term capital gain. In case Ram and Associates is a cooperative society, in case Ram and Associates is cooperative society, taxability will not arise under section 45.4. Then section 45.5, this is very important one. Here it is, 45.5 is compulsory acquisition under any law. So compulsory acquisition under any law, or the transfer the consideration of which is determined by or approved by central government or RBI. So fundamentally here, year of transfer, when the capital asset is transferred, as per 247, it is included in the ambit of transfer compulsory acquisition under any law. So year of transfer is year of compulsory acquisition. Year of transfer is year of compulsory acquisition. Taxability will arise in the year in which the compensation or part thereof is first received by the SSE. The same will be taxable in the year in which the compensation or part thereof is what? First received by the SSE. In that year, the same will be taxable. Full value of consideration is The amount of compensation so determined. Full value of consideration is the amount of compensation which has been so determined. In case the compensation, you are not satisfied with the compensation and you went in court of law, compensation is enhanced or further enhanced by court tribunal, by court or say tribunal or other authority, the same has been enhanced or further enhanced by court, tribunal or other authority, then enhanced compensation will be taxable in the year of receipt, and cost of acquisition and cost of improvement same shall be taken as nil, shall be taken as nil in case of such enhanced compensation, in case of enhanced compensation. In case of the enhanced compensation, the cost section cost of improvement shall be taken as nil. And in case of interim order, of court, the same has not been yet finalized, an interim order has been issued. So the taxability will arise when final award is made. And final order is issued, then only the taxability will arise. And in case compensation is reduced, in case compensation is reduced, then in such case capital gains shall be recomputed. Capital gains shall be recomputed on the basis of reduced compensation. The capital gains will be recomputed on the basis of such reduced compensation. If any interest is received, on compensation or enhanced compensation, if the interest is received on compensation or enhanced compensation, same will be taxable under head income from other sources, will be taxable under head income from other sources in the year of receipt, and ad hoc deduction of 50% shall be admissible in respect of such interest. So what section 45(5) provides is where the capital gains arises from transfer of capital asset by way of, and transfer is by way of compulsory acquisition under any law, or the transfer the consideration of which has been determined or approved by central government or RBI, and the compensation or the consideration for transfer has been enhanced or further enhanced by any court, tribunal or the authority, then the taxability will arise as under full value of consideration is whatever amount of compensation or consideration the same has been determined will be full value of consideration. And year of taxability is what? The previous year in which the compensation or part thereof has been first received by the assessee. And in case the compensation is enhanced or further enhanced, in case the compensation is say enhanced or further enhanced by the court, tribunal or the authority, the same shall be taxable as capital gains in the previous year in which such enhanced amount is say received by the assessee. And full value of consideration shall be taken as the amount of what? Enhanced compensation. And whatever amount has been received on enhanced compensation, the same will be full value of consideration, and the cost action and cost of improvement shall be taken as nil. However, if an interim order has been issued, then we have already discussed the same. This taxability will arise only when the final order has been issued. And in case the compensation is say reduced, original compensation or enhanced compensation is reduced, then the capital gains shall be recomputed by reopening the assessment by taking into account such reduced compensation or consideration. And in case if enhanced compensation is received by the legal heirs due to death of the person or transferor or for any other reason, then the person in whose hands the compensation is received, the same will be chargeable to tax in his hands. So it will be taxable in hands of the legal heirs. As we already discussed, interest on compensation or interest on enhanced compensation, the same will be taxable under the head income from other sources, and ad hoc deduction of 50% will be admissible from such interest income. It will be taxable on receipt basis, irrespective of the method of accounting which has been followed by the assessee. Now, 1037 is dealing with 10 is exemption in respect of long-term capital gains arising on compulsory acquisition of urban agricultural land. So, in case of an assessee being an individual or HUF, in case of an assessee being an individual or HUF, any income is chargeable under the head capital gains arising from transfer of agricultural land. The same shall be exempt if the land is situated in urban area. The agriculture and land in rural area is not a capital asset, as you are already aware. Such land has been used during the 2 years immediately preceding the date of transfer for agricultural purposes by individual or HUF or its parents. And in case of compulsory acquisition is under any law, transfer is by way of compulsory acquisition under any law, the consideration of or the transfer by consideration of which has been determined or approved by the central government or RBI. And the income has been arisen on account of such compensation or consideration for transfer on or after 1/4/2004. Then 1037A, we were discussing that 1037A is under land pooling scheme. So any income chargeable under the head capital gains, any income chargeable under the head capital gains in respect of transfer of specified capital asset, transfer of specified capital asset being an individual or HUF who are the owner of specified asset as on 2nd June 2014, and he transfers that asset under land pooling scheme covered under Andhra Pradesh Capital City Land Pooling Scheme Formulation and Implementation Rules 2015, made under the provisions of the this Andhra Pradesh Capital Region Development Authority Act 2014. What the scheme specified asset here means, that is a land or building or both which has been owned by the assessee on 2nd June 2014, and the same has been transferred under land pooling scheme. Land pooling ownership certificate is issued under the scheme of the to the assessee in the land or building or both referred to in clause A. The reconstituted plot of or land, as the case may be, is received by the assessee in lieu of land or building or both, referred to in clause A in accordance with the scheme. If such plot or land, as the case may be, so received is transferred within 2 years from the end of the financial year in which the possession of plot or land has been handed over to him. So fundamentally, the exemption will be available if such land or plot is transferred within 2 years from the end of FY in which possession of plot or say land was handed over to him, and in case if the same is not transferred within 2 years, so the SDV, the stamp duty value, as on last day of second year shall be taken as what? Cost section for computing capital gains, which we were discussing here. So here under a land pooling scheme, you are given the land and you have been allotted reconstituted land or plot of land, as the case may be, and you transfer the same plot within 2 years from the end of the financial year in which the possession of the plot has been given to you. Capital gains will be what? Exempt from tax. Now, when question is there relating to computation of capital gains, a piece of land is owned by Mr. Mishra at Jaipur Delhi Highway, acquired by NHAI in 2010-11. The same has been acquired by NHAI in 2010-11, but the award in financial year 11-12, ordered in financial year 11-12, the same was paid in 18-19. The land was purchased for rupees 1997 for 1,000, and fair market value was as on 1/4/2001 is 900, and compensation is rupees 5 lakhs. So here the full value of consideration, capital gains, will be taxable in financial year 2018-19 when the compensation has been received. Compensation so received, the same will be regarded as full value of consideration. 5 lakh is full value of consideration, less indexed cost of acquisition, that is 10-11 index is 167. It has been acquired for rupees 1000 upon 167 into 280, 1000 upon 167 into 280. It was when it was been acquired, it has been purchased so on 97, so that is 100, and when the compulsory acquisition has taken place in 2010-11, so it is 2010-11, you have to find out the index. So it will be 2010-11 index, and that is what? It will be 167. So it will be 16,000 1670. That is index cross section. So here year of transfer basically is year of compulsory acquisition. Year of transfer is year of compulsory acquisition. So long term capital gains will be how much? The long term capital gains will be 5 lakh minus 1670. That is 4 lakh 98,330. So here, as we have discussed, year of transfer. Normally what is done is this, but you have to keep in mind year of transfer is year of compulsory acquisition. Now, other piece of land located in Chennai was purchased in April 8 for rupees 25 lakhs, was sold for 45 lakhs, but sale deed could not be executed. It doesn't matter sale deed has been executed or not. What you have to apply is the stamp duty value. We'll be discussing the same. Stamp duty value will be regarded as full value of consideration. Here, full value of consideration will be stamp duty value since it exceeds 105, it is what exceeds 105% of the, it is what exceeds 105% of the actual consideration. So actual consideration is 45 into 105%, 47.25, it exceeds the same. Therefore, we will discuss the same in 50C. So 55 lakh rupees will be the full value of consideration. And what is the indexed cost action? Less indexed cost of acquisition. What is indexed cost action? 25 lakhs upon same has been acquired in 2008, 137 into year of transfer, that is 280. So 25 upon 137 into 280, that works out to be 51 lakh 9,489. This is the long term capital gain. So LTCG is 3 lakh 90,511. This is the long term capital gains. Now we'll be discussing section 45(5)(a), that is special provisions for computation of capital gains in case of joint development agreements. So the provisions of section 45(5)(a) is applicable in case of individual or Hindu undivided family. And here the individual or HUF has entered into agreement with builder, and basically they are transferring their development rights. This transfer of development rights, and consideration is in form of construction of flats plus money. So the provisions of section 45(5)(a) is applicable in case of individual or HUF, and capital asset transferred is land or building or both under a specified agreement. And basically specified agreement means a registered agreement in which the person who is owning a land or building or both agrees to allow to develop another person, basically the developer, he allows another person, that is a developer, to develop a real estate project on such land or building or both in consideration of share being land or building or both in such project. Share of in consideration of share being land or building or both in such project, whether or without, with or without, say, payment of or part of consideration in cash. So here specified agreement is entered into with the builder, and they will, you are transferring your rights of land building, and in that particular case they will be giving you constructed flats, or some amount may be given in money form also. So here the year of taxability will be, the capital gains will be chargeable to tax as the income of the previous year in which the certificate of completion for whole or part of the project is issued by the competent authority. When certificate of completion for whole or part of the project is issued by the competent authority, that will be the year of taxability. And what will be the full value of consideration? The stamp duty value on the date of issue of the said certificate of his share being land or building or both in the project. Whatever his share is in the land or building or both in the project, as increased by consideration which has been received in cash, if any, the same shall be deemed to be full value of consideration received or accruing as a result of transfer of the capital asset. And stamp duty value is the value which has been adopted or assessed by the stamp valuation authority for payment of stamp duty. And in case where the assessee transfers his share in the project on or before the date of issuance of the said completion certificate, then capital gains will not be computed as per the provisions of 45(5)(a), but normal provisions of the Act will apply to determine for the purpose of determining full value of consideration received as a result of such transfer. So here, an individual or HUF is entering into an agreement for development of project. If in case the individual or HUF has transferred his share in the project after the date of issuance of completion certificate, well, yes, then capital gains will be chargeable to tax in the year in which completion certificate has been issued, and the stamp duty value on the date of the issue of certificate of completion plus cash consideration which has been there, that will be regarded as full value of consideration. And the full value of consideration which has been here deemed to be full value of consideration, the same will be taken as cost section for those flats which are subsequently which will be transferred. And in case if the individual or HUF transfers his share in project before the issuance of the completion certificate, in such case the capital gains tax liability would arise in the previous year in which the property is handed over to the developer. Now, one question is there. X purchased a plot of land in Jaipur on 15/4/2001. The plot of land was 1500 square meters. Cost of action is 10 lakhs. The same has been acquired for 10 lakhs, and it has been acquired on 15/4/2001. He enters into a specified agreement with A Limited, a developer, on 20th April 17 for cash consideration paid immediately is 51 lakh, and total area to be developed is, here area to be developed is 45,000 square feet. Share of X Limited in construction area is, share of X Limited in the constructible area is 60%. 60% is share of what? X Limited. Share of X is 60%, and share of A Limited is 40%. So it will be getting 60% of the built up area, and 40% will be retained by whom? The A Limited. So hence E has transferred as such 40% rights of land and building. Whatever the rights of land and building, 40% of the said rights have been transferred, so that 40% will be retained by whom? Share by A Limited. Construction of the project is completed on 1st March 19, and completion certificate has been given by to the entire project on 10/3/19. The stamp duty value of 60% of the developed area given to X is 36 crores. So 60% developed area has been given, and stamp duty value is rupees 36 crores, and besides this, what is been retained by A Limited is 24 crores, and cash consideration is also there, 51 lakhs. 51 lakh is the cash consideration. So here taxability will arise in the year in which project is completed, that is financial year 18/19. What is the full value of consideration? 36 crore. 51 lakh is the full value of consideration, less index cost section. The land was acquired for rupees 10 lakhs, and 40% rights have been transferred to A Limited, 280 upon 100, that is 11 lakh 20,000. So long term capital gains will be 36 lakh 36 crore 39 lakh 80,000. That will be the resultant long term capital gains which are chargeable tax in hands of X Limited. Now section 46 is computation of capital gains in case of liquidation of company. That is computation of capital gains in case of liquidation of company. 46 is computation of capital gains in case of liquidation of company. In hands of company, that is in hands of company, (46)(1) provides that in hands of company, it is not regarded as transfer. It is not regarded as transfer. In hands of company, the same is not regarded as transfer. In hands of shareholder, taxability will arise. Whatever is the cash plus market value of assets received on liquidation that is cash plus market value of the assets which have been received on liquidation. From that, whatever his share in deemed dividend under section 222C, the profit share, and in that case remaining amount is full value of consideration. Remaining amount is full value of consideration, and the cost or index cost of acquisition of shares will be reduced to find out the resultant capital gains, less cost action or index cost action of shares. Same will be reduced to find out short term capital gains or long term capital gains. When shareholder subsequently sells the asset, the capital asset received on liquidation, the FMV of such asset the fair market value of such asset shall be taken as cost of acquisition. The FMV of such asset same shall be taken as cost of acquisition. So here value of other assets, that means even if rural agricultural land is received, capital gains will arise. Same has been judicially decided by the Supreme Court in N. Bhagwati Ammal's case. And we have already discussed, as per the provisions of section 55(2), whatever asset is received, the fair market value of the asset, the same shall be taken as what? The cost of action. Now, one question is there. Mr. Raghu purchased 10,000 equity shares of AB Avenues Private Limited on 25/3/2005 for rupees 1,20,000. Then the company went on liquidation on 31/7/18 and the share position has been year under. There's urban agricultural land that is of 22 lakh rupees, cash at bank is there, general reserves is there, and liability of for income tax is there. Now, the assets remaining after discharging the liability for income tax were distributed to the shareholders in the proportion of their shareholding. The market value of agricultural land is rupees 60 lakhs, and agricultural land received above by Mr. Raghu on say 28/2/2019 is rupees 15 lakhs. Discuss tax implications in hands of Raghu. In case the cost inflation index of 2004-5 is say 113 and 18/19 is 280. So here when we compute capital gains in hands of company, it is not regarded as transfer. In hands of company, the same is not regarded as transfer. Then in hands of shareholder, the taxability will arise as under. That is what? Amount received on liquidation. Whatever amount has been received on liquidation. So here the amount which has been received on liquidation, say 32 lakh 22,012 212 is cash, and after retaining, after paying the income tax liability, so here from 32 lakh 22,212 minus 822,212. This is liability which has been met out. So here cash remains is how much? 24 lakh is the cash. And Raghu's share is 10,000 shares he is having out of 60,000. So Raghu's share it works out to be 1/6. So 1/6 share is in cash, that works out to be 4 lakh rupees is his share in cash. And besides, he has received agricultural land 60 lakh 1/6 share, that is 10 lakh rupees agricultural land has been received. So how much he has received is cash, that is 4 lakhs, plus fair market value of asset received on liquidation, that is 10 lakhs. So it works out to be how much? 14 lakhs less share in deemed dividend, under section 222C. The accumulated profits after making provision of this dividend distribution tax is 40 lakh rupees, that is general reserves. So his share is 1/6 share in accumulated profits. Same will be regarded as what? Deemed dividend, that is 6 lakhs 66,667. Remaining amount will be regarded as full value of consideration. This is full value of consideration. So full value of consideration here is 7,33,333. Whatever is less indexed cost of acquisition of shares, the shares have been acquired for 1,20,000 divided by 113 into 280. 1,20,000 divided by 113 into 280, that is 2,97,345. 2,97,345. So long term capital gains will be that is 4 lakh 35,988. And when shareholder subsequently sells such agricultural land, full value of consideration for that agricultural land, it will be 15 lakhs less cost section 10 lakhs, 5 lakh rupees will be the short term capital gains. So here 5 lakh rupees will be the short term capital gains. Now 46A is computation of capital gains in case of buyback of shares. That is 46A. Computation of capital gains in case of buyback of shares. So here buyback is by say listed company or unlisted company. If buyback is by listed company in hands of company, if listed company buyback the shares in hands of company, no dividend distribution tax DDT liability arises when distribution is of reserves to shareholders on buyback, since it is not regarded as dividend. Since not regarded as dividend in hands of shareholder, in hands of shareholder 46A applies. That is, full value of consideration is amount received on buyback less whatever is the cost of action or index cost action of shares. Same is reduced to find out capital gains. Same is reduced to find out what? Capital gains. And in case of unlisted company, and in case of unlisted company, company is liable to pay tax under section 115 QA. If buyback is by unlisted company, then company is liable to pay tax at under section 115 QA at rate of 20%, that is 23.296%, and in hands of shareholder, such amount will be exempt from tax under section 1034A. And in case buyback is routed is through recognized stock exchange, then provisions of section 112A applies in case of listed companies. So this we have discussed taxability in hands of buyback in case of unlisted companies. company is subject to additional income tax at rate of 23.296%. Unlisted companies are there under section 115 QA, and in case of shareholders, the same is exempt under section 1034. Same is exempt under section 1034A. And when it is other than unlisted company, the same is not subject to tax in hands of company. Income arising to shareholders is chargeable to tax under the head capital gains. Now, section 50 is computation of capital gains in case of depreciable asset. That is computation of capital gains in case of depreciable asset. This we have already discussed under profits and gains of business and profession. How you will be computing, that is the written down value of the block of asset at the beginning of the year. What is the WDV of the block of asset? Whatever asset at actual cost of asset acquired during the year, less money is payable, less money is payable to the assessee. In respect of assets sold, discarded, demolished, or destroyed, same is reduced, and the resultant sum, if these monies payable increase is in excess of what is the value here, then it will be a short term capital gains. And in case if all the assets in the block are sold, falling in block are sold, and the sale proceeds is less than the WDV, and sale proceeds is less than WDV, resultant loss will be short term capital loss. That will be regarded as short term capital loss. So, this we have discussed. Then, in case of undertakings which have been engaged in generation and distribution of power, if they have purchased a asset on which depreciation is claimed under SLM basis, they have purchased an asset for 25 lakh rupees and they have claimed depreciation on SLM basis under section 3211. Say they have claimed depreciation of rupees 10 lakhs, 15 lakhs is the WDV, and asset is sold for say 18 lakhs or 30 lakhs. We have discussed the same in case of undertakings which are engaged in generation of power or say generation and distribution of power. In such case, in first case there will be 3 lakhs rupees, 3 lakh is short term capital gain. Here to the extent of the depreciation so admissible. So this 3 lakh is business profit, sorry, business profit, that is balancing charge. And in this case, to the extent of depreciation admissible, the same will be balancing charge. That is 10 lakh rupees will be regarded as balancing charge. And whatever proceeds are over and above the original cost, that is the same has been sold for 30 lakhs. The cost is 25 lakhs. So 10 lakh, 5 lakh rupees will be short term capital gain or long term capital gain, depending upon the period of holding. Depending upon period of holding. So this will is in case of undertakings which are engaged in generation of power or generation and distribution of power and who has claimed depreciation under section 3211. That was 50A. Now section 50, that is section 50B, is a very important section, that is slump sale. Slump sale. Basically here undertaking or say division is sold for lump sum consideration. The undertaking or division is sold for lump sum consideration without assigning values to individual assets and liabilities. That is coming under the ambit of slump sale. So, what slump sale means? It means transfer of one or more undertakings. It means transfer of one or more undertakings as a result of sale, as a result of sale for lump sum consideration. That is for lump sum consideration without values being assigned to individual assets and liabilities. So if the undertaking or division here, basically undertaking or division itself is a capital asset. And how the computation will be made, that is 50B, that is slump sale. What is the full value of consideration? That is the lump sum consideration. So received, the same will be the full value of consideration. Then what will be the cost of acquisition? The net worth of the undertaking. The net worth of the undertaking or division so transferred. What is the net worth of the undertaking or division so transferred? The same will be regarded as the cost of acquisition. And here, no benefit of indexation is available. You will not be getting any benefit of indexation in such a case. In case undertaking or division is held for more than 36 months, it will be regarded as what? Long-term capital asset. And this net worth, the same is to be certified by chartered accountant. And how you will be calculating the net worth? That is computation of net worth. That is aggregate value of the assets. Here, aggregate value of the assets, it includes WDV, WDV in case of depreciable asset. That is WDV in case of depreciable asset. And WDV will be arrived as per the provisions of section 43(6). Book value, book value in case of other assets. And in case of assets on which deduction is claimed under section 35 AD, it will be taken as nil. Whatever is the, if any revaluation is made, same is to be ignored. If you have made any revaluation, you have to ignore it. And less what? Aggregate value of asset minus less what? Aggregate value of the liabilities appearing in the books that will be reduced. And this will is net worth. Now one question is there, PQR Limited has two divisions, two units. One is engaged in manufacture of computer hardware and other is involved in developing software. As a restructuring drive, company decided to sell its software unit as a going concern by way of slump sale for a consideration of rupees 385 lakhs to new company called S Limited, in which it holds 74% equity shares. The balance sheet of the company is on 31st March 2019, being the date on which unit has been transferred, is given here under. So here fixed assets software division has been sold. So to consider assets for software units, there's 200 lakhs, debtors 110 lakh, 110 lakhs, inventory is what? 35 lakhs. So here the software unit is in existence in May 11, so it is long-term capital asset. Gains will be long-term capital gains. Fixed assets of software units includes land, which was purchased for rupees 40 lakhs, and the same has been revalued at rupees 60 lakhs. So we will have to exclude this. We'll have to consider only 40 lakhs. Fixed assets of software units, that is 140 lakhs. 200 lakhs minus 60 lakhs is the value of land. WDV as per the books of accounts is 140 lakhs, and as per the income tax side we have to consider, that is 90 lakhs. So first of all you will be computing the net worth. That is computation of net worth of software unit. We'll have to compute the net worth of the software unit. So fixed assets other than land, for them WD will be taken as per 43(6), and they have given that this WDV is how much? 90. Then land is 40 lakhs. Besides the debtors, 110 lakhs, and inventories is 35 lakhs. That is inventories, that is 35 lakhs. So here the aggregate value of the assets is 35, 200, 235, and 275 minus aggregate value of the liabilities, that is 90. So 185 is basically the net worth. Net worth is 185. Same is sold for 385 lakhs. So 385 minus 185. Resultant sum is long-term capital gains, which is equal to 200 lakhs. LTCG is 200 lakhs. Ascertain the tax liability. So 200 lakhs, rate of tax on long-term capital gains is 20%. That is 40 lakhs. The same is to be increased by surcharge at rate of 7%. That is 2.8 lakhs. 42.8 lakhs, and it is to be increased by HEC of 4%. So your liability works out to be 44.51 lakhs. What would your advice as a tax consultant to make restructuring plan more tax savvy without any changing the amount of sales consideration? So here 70% ownership is with the company which is transferring the division by way of some sale. So here it can acquire further 26% shareholding to make acquiring company 100% subsidiary. So if you transfer any capital asset to your 100% subsidiary company, then in that particular circumstance, capital gains will not arise. And in case if acquisition is not possible, 26% acquisition is not possible, then PQR Limited may also plan demerger, and if any assets are transferred in scheme of demerger also, taxability will not arise. So this can be your advice. You acquire 100% shares, that is 26% further acquisition, make that company subsidiary company, and in case when any assets are transferred to subsidiary company, in such case taxability will not arise provided fulfills the other conditions and there is no withdrawal under section 47A. Now section 50C is full value of consideration in certain cases. So where we transfer land or building or both, and the stamp duty value exceeds 105% of the actual consideration. In such case, stamp duty value is full value of consideration, and we have to take the stamp duty value on the date of registration. However, if the agreement has been entered prior to that date and consideration has been paid by, say, account pay check, account paid bank draft, or use of electronic clearing system, whole or part of the consideration on or before the date of agreement, stamp duty value on the date of agreement will be considered. So where the consideration received or accruing as a result of transfer of an transfer by an assessee of a capital asset, say being land or building or both, is less than the value adopted by the stamp valuation authority, that is the stamp duty value, then the stamp duty value will be regarded as full value of consideration. And now an amendment has been made that here, if the stamp duty value exceeds 105% of the actual consideration, then only we'll have to consider the stamp duty value. Otherwise, whatever the actual consideration, the same is to be taken. And in case the stamp duty value on the date of agreement will be taken if any amount of consideration which has been received, say through account pay check or account pay bank draft, or use of ECS on or before the date of such agreement. And in case if the assessee is not satisfied with the value which has been adopted by the stamp valuation authority, then he can make a reference to the valuation officer and apply to the AO for making a reference to the valuation officer. And if the value determined by the valuation officer is less than the stamp duty value, then the value so determined by the valuation officer will be taken as the full value of consideration. And in case the value exceeds the value stamp duty value, the value that is determined by the valuation officer exceeds the stamp duty value, in that particular circumstance, the stamp duty value will be regarded as the full value of consideration. So, one question is there: from the following information, compute the taxable capital gains in hands of Mr. X. X has purchased a plot of land on 10th August 2008 for rupees 4,11,000, and the agreement has been entered on 1st of May 2018 for rupees 80 lakhs. Stamp duty value is rupees 83 lakhs. On 1st May 18, gets an advance of rupees 1 lakh by an account pay check. So here, since an amount is received as advance by account pay check on the date of agreement, we have to consider as DV on the date of agreement. As DV on the date of agreement is to be taken, and when SDV on the date of agreement is taken and it do not exceed 105% of the actual consideration, therefore, as per provisions of section 50C, actual consideration will be the full value of consideration. The actual consideration will be the full value of consideration. So here, the full value of consideration that is 50C is actual consideration, that is 80 lakh rupees, less the index cost of acquisition. Index cost of acquisition is what? 4,11,000 divided by 2000, index of year 2008-9, that is 137 into 280, that is 4,11,000 divided by 137 into 280, that is 8,40,000. So resultant long-term capital gains is 71 lakh 60,000 is the long-term capital gain. And the next part they are asking is, what would be your answer if you receive 1 lakh on 2nd May 18 instead of 1st May? So in that case, stamp duty value on the date of registration will be taken, will be considered. So stamp duty value on the date of registration is here 85 lakhs, which exceeds 105% of the actual consideration. So here the full value of consideration is 85 lakh rupees as per the provisions of 50C less index cost section is 8 lakh 40,000 rupees. Resultant long-term capital gains will be the long-term capital gains which is chargeable to tax. The same will be 76 lakh 60,000 rupees. So you have to keep 105% of the consideration in mind. Same amendment has been also made under income from other sources as well as while computing the PGBP. Then 50 CA is basically special provisions for full value of consideration for transfer of shares other than quoted shares. So in case of unquoted shares, that is the full value of consideration shall be determined in accordance with the rules which have been prescribed in this regard. And 50D is where you cannot determine the full value of consideration. In such a case, fair market value will be regarded as full value of the consideration. That is, the fair market value on the date of transfer, the same will be regarded as full value of consideration.